Thank you. Okay, good morning everyone, and welcome to our January EU Cross-Border Funds Forum e-seminar. I'm Karina Vaughan from Catalina Consulting. We specialise in supporting entrepreneurs in FinTech, RegTech and ESG with strategic business growth. And we work with Simon Osborne and his team at IFI Global on research projects and events for the funds industry. Simon and I are joined this morning by an excellent panel of industry specialists to discuss EU-UK regulatory divergence. What do different approaches to ESG regulation mean for the UK and for Europe, and of course in particular for Ireland? Please submit your questions during the session, don't wait for the end, and we will try to get to as many of those questions as we can. Next week, we'll be sharing a short report with you, which will be a combination of our own research and the outputs from this morning's seminar. So I will now hand you over to Simon Osborne, CEO of IFI Global, for some initial thoughts before we move to the panel discussion.
Thank you very much, Karina, and thank you all for joining us this morning. We're absolutely delighted to have such a large audience for our first event of the year. It's a pleasant surprise to see, I think, something like 100 or more than 100 people who are supposed to be joining us this morning. For those of you who don't know IFI Global, I should just say that we are a research and media house based in the City of London. We have 3 monthly publications. One of them is called the Briefing Report, which specializes in the impact of ESG on the fund industry. And we believe that ESG will progressively change a number of industry practices, especially on the governance side of the business. The Briefing Report is also starting to track the adoption of ESG standards by fund industry service providers, for managers and others who want that information. What I'm going to do is give us all a very short intro presentation, then we're going to get into the panel discussion. So here are some big questions, in my view, for 2021. Really, how much divergence is there going to be between the EU and the UK fund industries, and how will that impact the development of the business in both the UK and in the EU? Although we won't really be getting into this topic this morning, to me it looks unlikely that there will be an equivalence agreement between the EU and the UK on financial services. As you doubtless probably will know, financial services were not covered in the trade and cooperation agreement that just got over the line before Christmas. And I noticed, quite interestingly, Andrew Bailey just last week, the ex-head of the FCA before taking on the position of Governor of the Bank of England, said that the UK cannot be, quote, a rule taker on financial services with the EU, which he thinks and others think, including me, is what the EU doubtless wants. And Rishi Sunak has already announced very publicly that there will be divergence from the UK's point of view. He specifically mentioned Solvency II and PRIIPs. I'm amazed he's ever heard of PRIIPs, but he did actually refer to that as well as Solvency II. And all of these topics are fascinating to us at IFI Global in our publication, The Tracker, and we will be getting into that in an awful lot more detail in future online seminars. So the first test of this divergence, if that's what it is in the area of ESG. And you couldn't have hoped for a more interesting area to test the divergence than we are about to see coming up very shortly. But before we get into that potential divergence, it's perhaps worth reminding us of just the extraordinary onward march of ESG. JP Morgan forecast sometime last year, we will see shortly whether they were right, that the globally, all assets in ESG would reach the astonishing figure of 45 trillion by the end of 2020. Institutions who support the UN's PRI, which is where ESG comes from, as I'm sure you know, have over $70 trillion in assets, so potentially we've got some way to go yet. According to Morningstar, European ESG fund assets passed the $1 trillion mark last year, and astonishingly, 40%, therefore obviously nearly half of all the inflows into European funds in the third quarter last year were ESG related. To add to all of that, we in a few days' time have Joe Biden taking over as the president in the US. One of the big planks of his campaign was his Green New Deal. So the US is joining the party. That will, I think, help the development. Obviously, it will help the development in the States and probably globally too. And I love this quote finally from Olivier Carré of PwC, who wrote a very large report for PwC last year on ESG. And he said in that ESG is, quote, a once in a century opportunity. Now, there are skeptics on ESG, and it's true that you do see in thematic investing, and ESG is thematic investing on stilts, bubbles very often being created. But I personally think, and I'm sure the vast majority of you following us today would also agree, that ESG is sufficiently different for that not to necessarily happen in the same way here. So I'm now going to quickly mention the SFDR. I'm not going to get into this in any detail now because we have a panel of experts that know an awful lot more about the SFDR than me. Just a quick timeline. It's almost upon us. It starts on the 10th of March, and there's various milestones or markers along the way. I've put them on the screen here. We'll get into the SFDR in more detail in a minute. The issue about divergence, however, is that late autumn last year, the UK announced to several people's surprise, not least my own, that it would not be, at least for now, following the SFDR, and it's coming up with this thing called the TCFD, where TCFD has been around for a long time. We put there, it goes back to 2016. It stands for the Task Force on Climate-Related Financial Disclosures. It's very different from the SFDR. It's market-based, it's much more user-friendly, and it focuses entirely on the environment. There's none of the social stuff which you see in the SFDR. But, and there's an important three elements to the but, the UK will adopt the framework for the EU's tax economy and is establishing a, quote, green technical advisory group to review the impact of the SFDR. So it's still possible that it will adopt something like the SFDR. That may happen. Secondly, and this is absolutely critically important and is without any doubt going to happen, UK managers will have to comply with the SFDR if they're distributing funds in the EU, including if they're doing it, say, via the Channel Islands in a private placement type arrangement. And also, UK and other non-EU investors may well put pressure on UK managers to become SFDR compliant in the months and years ahead. So the UK is not escaping from the SFDR necessarily, but it's not joining it at the moment either. And I'll be very interested to see whether or not the UK feels, say, by the end of this year or perhaps the year after next, that it is going to have to do something along the same lines, being in the European region. And if it does, it probably will imply a lot of things for other areas of financial regulation. And of course, if it doesn't, it will also imply a lot of things for financial regulation too. Various points quickly to ponder before I introduce the panel. And these are the topics we're going to be getting into in a second. Will the SFDR stimulate ESG investing? And if no, will something, and something similar is not adopted by the UK and the US and Australia and Canada and elsewhere in the world, where will that leave the EU, which we'll get into that in subject in a minute? Will Europe, and this goes beyond ESG and to all forms of regulation of the fund industry and indeed beyond the fund industry, will Europe benefit from having different regulatory approaches in the same region? So at last, if you will, ESMA might have some competition as a regulator with the FCA, and bearing in mind, of course, the UK financial services industry, fund industry is huge in relation to other countries in Europe. So it'll be very interesting to see how that relationship develops. And the first tester, as I've already said, is going to be in the area of the SFDR and ESG regulation overall. Beyond regulation, will ESG investing change the structure of the asset management industry? Where, as I said earlier, it's around 45 trillion globally in assets potentially and growing very quickly indeed. And will fund managers and their service providers adopt ESG standards themselves? I think the industry has been slow to appreciate that ESG is more than just an investment strategy. It does change business practices. It certainly, the managers have been putting pressure on their targets for investment to change practice. For example, put more women on boards, be more diverse, and a whole bunch of other things. Goldman Sachs Asset Management announced this time last year it would not invest in any corporates if they didn't have at least one female on their board. But the industry itself has been very poor at following that example. It's more of do as I say, not do as I do. Will that change? We think it probably will, which is what our publication, the briefing report, is all about. So that's enough for me. I want to hand over to the panel. Before I do, I want to thank Invest Northern Ireland very much for sponsoring this seminar this morning. And I would like to introduce Tracy Tookey, who's Group Head of Risk and Compliance at Centaur, and Stephen Carson, who's a partner in A&L Goodbody in Dublin, and Dewey John, who's Head of Research UK and Ireland at Refinitiv Lipper. I'm going to ask all three of them to make brief introductory comments, then we're going to get into the Q&A session. And as Karina said, please do put in your questions as we go along. We hopefully will come to some of them as we do go along, but we will also reserve probably about 10 minutes at the end specifically for questions too. So if you put in a question and it's not necessarily relevant to that part of the discussion, we may leave it till we get to closer to the end. So I'm going to stop sharing screen and hopefully our panel will come up in larger size. Oh, fantastic. And there's Stephen as well. And Tracy, can I come to you first for your opening comments?
You can indeed. Good morning, everyone. I guess, as you're probably aware, the firm I work for, Centaur, we provide fund administration and fiduciary services to a range of fund types, and in particular the alternatives industry. And the perspective I guess I can bring to the discussion, I hope, is very much from a practitioner point of view and what we're seeing and hearing from investors, from our clients and from our peers in the industry. And I know, Simon, you're very excited about the UK's opportunity to diverge as you normally are. I actually think in this area, maybe you'll need to save your excitement for a different regulatory area, because I don't think the UK is likely to really diverge in any material way in reality from Europe. I don't think its own industry wants it to do that either. And I think, I suppose my whole thrust of my thinking on this is that I would probably downplay the role that regulation plays in the continued evolution of ESG and investment practices. It is helpful absolutely, and investors welcome it, but I don't think it's pivotal, and I don't think it should hijack the agenda for ESG, and it can only achieve so much in that arena. This is an investor-driven concept and a movement, as we see. I think the industry probably could do more focusing on issues around data quality, around the rating agencies, etc., in order to facilitate their investment process, thinking around ESG. Most credible managers, are really struggling with the quality of the data available in this arena, and I'm sure some other panelists can talk a little bit more about that. So I think rather than being regulatory focused, the focus is more about what the industry can do, and that's all players in the industry: the investors, the investment management community, the service providers like ourselves, and so on, and also the governments in the respective jurisdictions to buy in to more to ESG and make their jurisdictions more attractive and support their service providers in that area. So they're my kind of key points to start off with.
Well, thank you, Tracy, and thank you very much for taking what I said earlier before we started. We wanted some disagreement, so fantastic. I look forward potentially to tackling you a bit on that later. Stephen, can I come to you next?
Thank you, Simon, and good morning, everyone. I'm a partner at A&W Goodbody, which is an all-Ireland law firm in Ireland. So delighted to be part of this panel and be sponsored by Invest Northern Ireland. We have a very significant presence in Belfast, and I'm a partner in our asset management investment funds group, which is based in Dublin, though I'm currently based in our London office. So I very much give a view of the entire islands or the British Isles. So in our practice, we advise asset managers and investment banks on establishing management companies and funds in Ireland across the spectrum, from UCITS, including ETFs and money market funds, all the way to AIFs, including private equity, real estate and hedge funds. And I think it was very interesting, your reference to Andrew Bailey's comments last week. If you cast your mind back to the immediate aftermath of the referendum in 2016, across the asset management industry in the UK, at that point, there was no expectation that there would be equivalence or passporting available to UK asset managers once we got to a point where an agreement was put in place. And so asset managers were very focused on setting up management companies or new arrangements for managing and distributing funds across the EU post-Brexit. When you look at the Free Trade and Cooperation Agreement as it currently stands, while there is a reference in there to a commitment to agreeing a memorandum of understanding on financial services, as you mentioned, and as the comments of Andrew Bailey suggested, there is very little optimism of any level of equivalence. And so I think the asset management industry responded appropriately, recognizing that the British government would want to take the opportunity of diverging from Europe across a range of areas of regulation, but SFDR, as you point out, Simon, is the first. I would always caution that there is what's called the Brussels effect. Brussels or the European Union is an exporter of regulatory standards, whether that's manufacturing cars or widgets or manufacturing financial products. And from what we see, and as Tracy has noted from engaging with our UK-based asset management clients, they appreciate they're going to have to adopt SFDR for the funds the non-EU funds that they market into Europe and the EU funds that they promote from the UK. And they see adopting SFDR as giving them a competitive advantage to be able to compete in the European funds market, which is the largest ESG investment target market in the world. I think over 75% of ESG fund products in the world are domiciled in Europe. So I'm going to agree with Tracy on this one, Simon.
Thank you. Right, well, I'm being ganged up against, I can see this. Dewey, can I ask you for your opening comments?
Yeah, sorry, Simon. I'm afraid I'm going to have to disappoint you again, because I'm largely going to agree with what Tracy and Stephen have said. I'm head of research for UK and Ireland for Refinitiv Lipper. We're a fund data and analytics company, so obviously we're very focused on where fund flows are happening around ESG in general, particularly around Brexit at the moment. I think overall Brexit's going to be a negative for the UK fund industry, but not massively so, and largely for the reasons that Tracy said. There are huge pressures from investors and from fund management companies on government to align with European regs because they want European distribution from the UK and vice versa. There's also a layer of international, not simply national regulation that's coming from TCFD, which you've already mentioned, which is hugely influential, and the investors and asset owners throughout the world are paying particular attention to, GRI standards and SABSI. And these global standards are also driving a degree of convergence. As in terms of the effect of SDFR, I think the effect is overall going to be a positive one, because any comprehensive standards, even bad ones at the moment, will be a net positive for the investment industry. People need some kind of consistency across different regions, which will allow them to make judgments, even if those judgments need a lot of fine tuning. Lastly, in terms of the data, in my opening remarks, what we've seen, the UK isn't a major player in the ESG investment industry in Europe, despite being a predominant player overall. It was playing catch up over the period from when I looked at the data from 2005 up until the Brexit referendum, and it's since slightly fallen back. And you can see the major players are on a different growth path in terms of gathering ESG assets than the UK is. Whether that remains an embedded trend or whether that changes as a result of any regulations that the UK brings in, I think it's too early to say at the moment, but it's certainly something we're keeping a close eye on.
Thank you. Well, the first question that I'm going to put to you, in a sense, all three of you have kind of already answered, particularly you just now, Dewey, but the question is the SFDR a net positive or a net negative for the European fund industry? Rather than just saying net positive, assuming that's what you think it is, perhaps you could say why you think it's a net positive for the European fund industry, and what perhaps also the negatives could be, if you see any negatives at all. Stephen, could I come to you first on that?
Yeah, so I don't know if it is ultimately net positive or net negative, but I think the positives are that if you think about ESG investing, this is a long-term structural trend. You know, once upon a time, institutions considered their fiduciary mandate, limited them to considering shareholder value and financial. That's no longer the case. There is a critical mass of institutional investors in Europe, be it pension funds, insurance companies, who are specifically allocated to asset managers on the basis of ESG capability. And that means that they're here to stay. I think by bringing in these regulatory initiatives, SFDR and the taxonomy regs later on, what that should help to foster, and Dewey mentioned this earlier, is a level of market standardization, a level of consistency across the categorization of ESG products and the terminology used. That has to help investors in terms of making choices about the ESG products that they will invest in, and it has to help investors reduce the risk of greenwashing or mis-selling of ESG products. So that has to ultimately benefit managers. I think in the negative column, though, you know, you're looking at an industry, particularly on the liquid end of the spectrum, which experiencing significant fee compression, has undergone 12 years of incredible regulatory change and the additional costs that come with bearing that burden of regulatory change. So adding this new layer of regulatory change, and when you add in the cost of the data required for some of the reporting, I think that's where the negative comes from. You would hope, though, that asset managers will see that the positive outweighs the negative in terms of being able to achieve fund flows and greater.
Thank you. And we're having a slight difficulty on your sound. We just got that, but just so you're aware, it was a little bit jumbled. But Tracy, can I ask you for any comments you have on whether the net positive, net negatives, and what you see on both sides of the ledger? I know you're going to say it's for your opening comments, it's a net positive, doubtless. But what's your overall view on that?
Yeah, I mean, I think it is a net positive, but maybe to bring back to my point is, you know, I think the role that regulation has to play in this has to be, you know, put into perspective. So I don't. There are certain things that I think need to happen within the industry around ESG that regulation isn't the cure for. And indeed, if there were a move to over-regulate either by gold plating or by Europe, you know, increasing regulation in those areas, it could actually have the opposite effect of distracting the industry and having this kind of you know, one size fits all mentality or a tick boxing mentality. We're not actually hitting the things that the industry needs to achieve in order to meet its ESG objectives. So I think overall, yes, net positive, but I think we should temper how far regulation tries to go on this, and the industry should not let it get run away with itself.
Okay, for you, Drew, I'm going to move slightly on to the next question, because you kind of answered a lot of that in your opening comments in the first question. But will, in your view, the SFDR stimulate investment in ESG funds across Europe? And would that be a fair metric to judge it by? If it doesn't, or if it does, is that one of the ways we can judge whether this thing has been a success?
Yes and yes. Shall I stop there? Can you hear me all right? Because people have been breaking up a little bit, not just Stephen. Yes, I think it's a fair metric to judge it by, and yes, I think it will stimulate fund flows. There's a lot of evidence that's been growing over time that increased disclosure increases investor confidence, and therefore they are more prepared to make investments, to pull the trigger on ESG investments. You still hear less in Europe because standards are higher, but in the US and in Asia, that large asset owners are holding back on ESG investments because the data quality isn't enough. Now, I know there have been complaints from European fund managers that what they're being asked to disclose, actually the data isn't there for at the moment, and that is a problem, or may well be a problem, with SDFR. And I think the challenge for that, and the real challenge overall for the industry, has to be higher up the chain to corporates and to governments in terms of what they disclose, and that will make the job for investors and fund management investment companies a lot more simple. But I think this will be a significant step forward. For all the clunky nature of it, no doubt at parts, I think this can be addressed. The UK will no doubt be watching this very closely, FCA, and learn the lessons from this. But it has to start somewhere, and I think it's very encouraging that this is going into operation, warts and all.
I'd like to ask both Tracy and Stephen whether they got any comments on that, and then we're going to move on to the next area where we might get a little bit of disagreement. But before we do that, Tracy or Stephen, would you like to comment on that?
I think I'd agree with Dewey at the outset that ESG investing is a long-term structural trend, as I mentioned earlier, but absolutely clarity of options, market standardization around product options has to help investors making investment decisions. And so that has to help continue to stimulate that trend, albeit I completely agree with Tracy's earlier point that you want to avoid over standardization, but I think that's where you will see boutique asset managers come into their own relative to some of the global fund managers in trying to distinguish their products from some of the ESG products of the larger behemoth asset managers.
All right, excellent. Tracy, anything, or shall we move on to the next area where we might be able to get our boxing gloves on and have a bit of a disagreement, or? And by the way, audience, just I repeat what I said earlier on. Please do feel free. Please fire in your questions should you wish to do so as we go along. I'll try and take them if we can as we do go along. Otherwise, we will reserve them for the end. Okay. What I'd like to ask you all is whether you think the SFDR or something very much like it will be adopted, not just by the FCA, but also by the SEC, the regulators in Canada, Australia, the Asia Pacific region, etc. And if not, and there's a very good chance it might not be the case, I'm sure everyone will be watching with bated breath to see what happens in the coming months. And there was a lot, as you will all know, there was an awful lot of pushback from an awful lot of managers. Some of this SFDR has been rolled out later as a result of the strong reaction from IFAMA and from many managers to the quite staggering amount of regulation that is coming their way. They were not happy with it. And you do get the impression in the European Union that we are in the UK no longer a part of, that people at ESMA and the European Commission wake up in the morning and they go, what is it that we can regulate today? So the EU is first off with this quite enormous piece of regulation. There is a chance it will not be as successful as the Commission and ESMA would want. If that is the case, how does that leave the European Union in future years if, say, the Anglo-Saxon world, which is where most asset management is actually created rather than administrated, where will that leave the EU? It's got this very substantial, quite bureaucratic, very detail-oriented regulation called the SFDR, and the UK, the US, and many other countries go in a different route. Who would like to take that first? Dewey, would you like to have a go at that?
Okay, I'm not sure how much I can add to what I've said before. I think even if it to be a bad and onerous regulation, SFDR will still have been a positive thing because it will be a test case for other regulators. From what I understand, the regulators, ESMAs, are not being too prescriptive about it. There's an element of regulation light and self certification happening with fund documentations, which have to be in place by March the 10th. But I believe that, for instance, Luxembourg-based Mancos are able to self-certify on this for their clients. So we're not going to see a hard stop, or we shouldn't see a hard stop in many European markets on March the 10th. I don't think we're at a level yet with over-regulation where possibly I would, probably making too much out of nothing, have a slight disagreement with Tracy in that when we get asset owners globally complaining there aren't enough regulations in place, we don't have enough disclosure. I don't think we're in a position of over-regulation at the moment. If we do, I think European regulators are not so in love with their own bureaucratic standards that they won't take a step back from it in order to encourage business. And as I said, we're seeing regulators globally not just look at SDFR, but also taking inspiration from TCFD, GRI and SASB and the like, and starting to put together the building blocks of what hopefully will be some kind of a global convergence around that. I don't know if that answers your question or not.
Tracy, do you want to have a go with that? Since you made your quite interesting comments at the beginning. Go ahead, sorry.
Well, I don't disagree with Dewey in that, convergence is definitely the way when it comes to, international standards that help guide disclosures and the like. And, obviously around disclosures, the requirement to disclose and what those disclosures should contain, regulation certainly helps there. But I see this again. It's a global. It's a global issue. I don't think regulatory arbitrage is something that's going to give opportunities for any country or any industry in this arena. And from our perspective, most of the clients that we deal with, for example, in particular UK clients, they operate on a global basis. They are managing their business globally as a result. So I think the industry will be pushing regulators not to diverge and to converge more. But again, I think around the arenas of scoring and rating agencies and the data available to them, that's not something I think that can be regulated because, specific ESG investment strategies will be looking for specific data for specific purposes. Yeah. And, credible investors and investment managers see through, just like they did with the greenwashing and so on, they'll see through, the data feeds that they're currently getting, and that's what they're complaining about. They need better data, and I don't think I think that's beyond the capabilities of regulators. I don't think that's something that is the realm of regulators. It is the realm of the industry and the players in the industry that provide industry with the data and the services they need. And I think rather than relying on what regulators prescribe in terms of disclosures or reporting, more and more investment managers are seeking assistance from specific due diligence agencies, or doing their own specific bespoke due diligence for their own specific strategies and their own specific objectives. So, I guess I'm not maybe adding to the point of your question so much, but I think it's not really a point that regulatory divergence, or whether it's undercutting or gold plating, I don't think it's going to really make a difference in terms of what the industry actually needs to do and wants to do.
Okay.
I'd strongly agree with what Tracy said there with regards to data. I think that hits a nail on the head. Okay, thank you for that. I'd like to come to you, Stephen, and actually, please, if you'd like to comment on that, please do. But I want to move on to the next questions, which you'd be an ideal person to put to, because I think you said you're actually based in London, although with an Irish law firm, so you can see it from both sides of the fence, if that's the right way of putting it, which is why do you think the UK decided to, and it was quite a surprise, I think, to a lot of people, that decided not to adopt the SFDR. And it was quite late last autumn that the announcement came along that it was not going to follow that particular route. So why do you think the UK industry decided to diverge? And also, at the same time, perhaps you could answer the following question, which is, do you think overall, maybe even beyond ESG, is it going to be a net benefit or not to the European fund industry overall, if there are going to be these two different regulators in Europe, the FCA and ESMA? Over to you.
So first, being an Irish lawyer, Ireland being the remaining Anglo-Saxon common law English-speaking economy in the European Union, we'll very much miss our British cousins at the negotiation table, Commission, at the table at ESMA.
Come and join us on the outside. Sorry, that's a bit of a joke.
I would like to remind people that I think there's an 89% approval rating within Ireland, so it's unfortunate, or it's not like, but we will miss the voice of the FCA and the British government in Europe. You outlined, SFDR is unwieldy in its impact, but if I were to look at it through the prism of fund product, so UCITS is really the undisputed global ex-US investment product in the world. ESG products are primarily going to be UCITS. They're not only going to be distributed around the EU, they're not only going to be promoted by EU managers, but they're going to be promoted by UK managers, they're going to be promoted by US managers and Asian managers, and they're going to be distributed in South America, South Africa, Mid and Asia. So as SFDR is rolled out across those UCITS, it's going to become a global ex-US standard, and it will be accepted by investors in the world, and there will be a level of familiarity with it. So again, going to my earlier point, the EU is an exporter of regulatory standards. I've seen that with MiFID II. So I think SFDR is here to stay, and it will become an adopted global standard. And why the UK government has decided to as the first example of regulatory divergence, I'm not really sure. I think by relying on the TCFD as the basis for their disclosures regime, I think that aligns with the Johnson government's commitment to climate change. And I think one of the areas, or commitment to reducing the impact of climate change, that's very much a core principle of that government. And I think one of the areas that UK fundamentally is different in terms of policy approach to the EU is there isn't the same focus on the social aspects. And with the ever closer union that the EU is becoming, it became an uncomfortable place for the UK to continue to be part of. So I think it's not surprising that that area of divergence. But I think what's telling is that I guess it's a tacit commitment to adopt the taxonomy regulations, subject to a review of its appropriateness for the UK market. I think the UK government recognises that while you might be able to diverge from SFDR, you're going to have to use the language of the European market, and they are continuing, or they are planning to adopt. So I think that is an interesting difference.
Okay, thank you. I'm going to take we've got questions coming in. We're only about 10 minutes or less than 10 minutes away now from a more formal period for questions, but I'm going to put one of the questions we've got in, probably Dewey, it may be best to put this one to you. Independently of the SFDR and any other UK initiatives, and with a focus on climate change specifically, does the panel see action on the part of managers to ensure specific alignment with the 2015 Paris Agreement?
Yes. Again, I won't stop there. We're seeing an increasing, well, just by way of one example, if you look at the amount of fund launches that are flagged as ESG that have been occurring over the past 2-3 years, the proportion is steadily increasing. Also, they're utilizing a lot more the social development goals of the UN, which plug into the goals of the Paris Agreement. In parallel to that, with asset owners, you are seeing, particularly with pension funds, more and more of them start to explicitly align themselves with the goals of the Paris Agreement in their own documentation. So yes, there's a strong move towards that, and I think that starts to make the links between investor goals and their ability to implement them. Because if you don't have the products, if you don't have, you go back 5 years and ESG funds were largely equity based, and now you're seeing them extend much more across the asset piece. Still some way to go, but there's now much greater granularity, for instance, with bond funds and different bond offerings that will allow investors to implement their strategies in a way they weren't able to before.
Okay. Tracy or Stephen, do you want to add to that at all before we go on to the next question? You don't have to. We've got so much more to go on to. If you don't, what I'd like to do is perhaps change the line of attack just for a minute before we come back to some of these questions in the more formal Q&A, and actually go on to the structure of the business and what ESG might or might not do for that. And perhaps this is a question for you, Tracy. Based as I think you are, I know your office is in Dublin, but you live in Northern Ireland. I'm going to give you two questions at the same time. What do you think the opportunities are for both for fund servicing centres like Dublin and Luxembourg from ESG that perhaps aren't there today? And do you think at the same time there is a potential for an all-Ireland approach to ESG? Over to you.
Okay, well, I think a lot of the opportunities for Ireland, Luxembourg has definitely led the way, and Ireland somewhat missed the boat, I guess, as people have remarked before, in terms of the availability of fund products. But there has been some commentary recently through KPMG and in the Irish Times and towards the end of last year around, what more Ireland could do as a country in terms of, attracting more FDI in the ESG realm. But I suppose for me, focusing on the funds industry, it was quite nice to see a positive media coverage of the private equity sector in Ireland, with the introduction of the ILP structure finally for our industry, and which has been reported by the Irish funds industry as being a very important development and making Ireland a much more attractive country for setting up fund structures using this structure. But I mean, apart from, you know, the availability of product types and the sector and what it's doing, I think, you know, the industry is definitely moving away from looking at this through the prism of this is our ESG product, this is our ESG fund. And it's much more mainstream and much more, I guess, holistic in terms of not just embedding it in the investment process, not just embedding it in your risk assessment process in the investment management space, but looking at just how you're doing business, looking at everyone in the chain of the fund products that you have, not just looking at it as this is our ESG fund product, this is the disclosure, this is our blurb and our PPM and so on. So we're seeing, for example, as a service provider, you know, every day we get due diligence questionnaires from our clients, from investment managers, we get them from investors. And there is, you know, a standard ESG section in every one of them now. We are being asked as an extension of our clients, you know, what is our ESG policies? What are we doing in this arena? We might not be directly impacted by the regulations, but we're certainly seen as an extension of the fund, as an extension of our investment manager client, and we're expected to demonstrate that. So I think there are opportunities for our sector to, I guess, articulate what we're doing a little bit better through the lens of ESG, and then use that as a platform to then look at what more we can do to describe ourselves in those terms a little bit better than perhaps we have to date. And there are definitely opportunities. The Irish Funds has, you know, reported that they expect the ILP product to bring up to 20 billion additional capital to Ireland in our fund sector, and also up to 3,000 additional new jobs. And maybe just in terms of the Northern Ireland side on that, there isn't an infinite pool of talent in Ireland in the PE space. And if there are indeed going to be so many additional new jobs created and need to be filled, we need to start throwing our net out a bit further in terms of where we're going to get that talent, how we're going to access it. And Northern Ireland and our friends in Invest NI will attest to this, has a quite untapped pool of accountancy talent, for example, and has a budgeting reg tech and compliance sector as well, an indigenous sector. So there are opportunities to fill those gaps, I think, by having a more all-Ireland approach to appointments and recruitment, and utilising the skills and the services that we have all Ireland. Obviously, there may be tax and regulatory things to overcome, but I don't think they're insurmountable. So I think, yeah, there are definitely opportunities for an all-Ireland approach in that sense, and for, you know, to meet the demands and hopefully live the dream that this ILP hopefully is bringing to our sector.
I don't know whether you want to comment on that quickly, Stephen, before we go to the questions. By the way, there are 2 private equity specialist fund administrators in Belfast already, so that may be a great time for them coming up.
I would fully agree with Tracy. I don't think ESG regulation will be the lever that will bring the communities together and create a united Ireland. And while the Northern Ireland Assembly doesn't have financial regulation as one of its competencies within the devolved government, so we won't have regulatory alignment. But I fully agree with Tracy, where you see an all-Ireland industry is in terms of talent and resources. If you compare us to Luxembourg, Luxembourg has one city, one population centre. It imports its talent across the borders every day in its fund services industry. In the Republic, we've got 4 major cities and population centres. In Northern Ireland, you've got 2. You've got a very young, educated population. You see organisations like large global administrators and the private equity service providers mentioned, Simon, who are both in Dublin and Belfast, and whether that's supporting and servicing European funds, or whether it's supporting maybe a growing population of domestic UK funds post-Brexit, I think that's where you'll see an alignment on an Ireland basis. One point I just make about the opportunity for Ireland generally, the Irish government in its National Financial Services Action Plan Restate 2020 set out sustainable finance and green finance as a very key element of that plan. A good indication of how we're doing in this space is at the end of 2019, Dublin was considered a ranked venue for the listing of green funds in the world. From my own practice, where we see ESG products or significant growth is really in the ETF space. That's where you see the preponderance, I think, of ESG product. And Ireland is the leading and continuing growing ETF domicile in Europe. And I think we'll continue to see Ireland as a hub for ESG product in that space. I'd also agree with Tracy and welcome the development of the investment limited partnership reforms that should drive further growth in illiquid asset classes in Ireland. And I think private equity managers and private managers are increasingly focused on sustainable investment as well. So that's certainly something to be welcomed. And I think positions the island of Ireland well to take advantage of these opportunities.
Thanks. Well, let's go to the questions now. Karina, shall I carry on with the questions, or would you like to put them? How would you like to do it?
So I think there's one I'd like to just put in at this point, following Stephen's comments there. And obviously Tracy spoke about different jurisdictions investing in ESG to attract new opportunities, new jobs, etc. So the UK has enshrined its commitment to net zero to law, and Ireland has not yet done so. Will that be a disadvantage from the perspective of the ESG industry and also from the perspective of FDI? So who would like to take that?
Don't all speak at once. I think the lawyer is probably the best equipped, Stephen, to.
Glad you said that, Simon.
You know, I saw that article in the Irish Times about the impact on FDI, and I don't necessarily agree with it. I think the Irish government may not have made the same commitment to net zero carbon emissions as the UK government, but we've taken other steps, and in particular, one of the first governments in Europe to divest from fossil fuel investments. Ireland has a long tradition in renewable investing. We're one of the real clusters or hubs in renewable energy technology. And in fact, some of the largest asset managers have set up renewable energy infrastructure businesses in Ireland to tap into that expertise. I think there are different ways nationally to demonstrate your commitment to reducing the impact of climate change and ESG policies generally. So I'm not sure that is something that will necessarily have an impact on our
I think what Stephen says there is a good point, and it's to illustrate the opposite. UK indices are still, in global relative terms, very much overweight in fossil fuel industries.
Okay. There's a question that follows on quite neatly from what Tracy was talking about a minute ago. Somebody has asked, could you shed more light on what types of data are currently available and which areas are lacking, in particular in relation to private equity funds, including underlying companies? That's a very good question when it comes to private equity and underlying companies, particularly since, Tracy, you raised the subject of the ILP. Does the SFDR get into that level of granularity? Anyone want to answer that?
I can only sort of give a little bit of insight in terms of, a bit more flavor around the issues of quality of data, the kinds of things that are missing. From our clients, we're hearing that there's a massive bias towards the larger companies, that have machines in-house to churn out due diligence data and answer all the right questions. So there's a bias towards the availability of data, and then obviously there's the quality of that data as well. So it's not as diverse as it needs to be, and particularly for smaller sectors and companies. So that's kind of the main thrust of where we're seeing. In terms of whether FDR goes into that. I think it's Stephen can talk more probably to that, but it's less focused on that and more focused on disclosure and reporting requirements for the moment. But maybe the technical standards and further developments in the regulation might tap into those things. I'm not really as hot on that, but that's where I'm coming from in terms of what's lacking and availability versus lack of availability of data.
Okay, thank you for that. Anyone else want to answer that? There's a question otherwise from somebody. How would these EU regulations compare with ESG regulations in Asia, Singapore in particular? Don't know if there is any ESG regulation in Asia, but Dewey, you might know better than anybody else here.
Yeah. Asia's very much playing catch up, both in terms of ESG assets and also in terms of ESG regulation. So the Hong Kong Monetary Authority, for instance, is increasingly implementing some interesting, I think probably quite effective ESG standards. I'm doing this from memory, forgive me. It's not something I've genned up on before this, but I think Malaysia and Indonesia are both implementing ESG standards, although ESG also has Indonesia also has quite a record for greenwashing. There's a lot of, having spoken to regulators and asset owners in Asia, there's a lot of focus on TCFD as a global standard.
Really? Interesting.
In terms of the impact on that. Yes, very much so. And that's why I emphasized in my introductory remarks that this the importance of this isn't simply at the national level to see what happens with SDFR. Regional regulators are looking at things like GIR, like SABSI, like TCFD, and starting to take elements of those and also utilize their own experience to develop their own standards. Speaking to Asian asset owners, although I've not had a conversation with any over probably the past 12 months, but national standards in Europe weren't something that they were particularly focused on, to the best of my knowledge, although I stand to be corrected on this.
Okay, we're almost out of time. I apologize, there's 2 or 3 people put some excellent questions in, but and some very technical questions in. Maybe we could put them to the panel afterwards and we can get back to you if you've given us your name and answer them that way, because otherwise if we try and answer them now, I'm afraid we'll go well past 12 o'clock. But I'm going to hand over to Karina, but before I do, I thank you for following this. Karina and I have been talking about possibly doing some research looking at the challenges that the industry has to overcome to really improve its ESG business practices. So we may have hopefully more to say on that before long. And as I said earlier, our publication, the briefing report, is really now starting to track ESG standards by service providers for managers and others who really are interested in that information, which you can find in our monthly in our publication, the briefing report. And with that, I'll hand over to Karina.
Okay, thank you, Simon. I would just like to thank all of you for joining us this morning. As I said, we will be producing a short report from this seminar, which should be in your inboxes by the end of next week. We have some seminars coming up in February. For those of you who were at our Dublin seminar, which we ran in association with PwC in September 2019. Unfortunately, we weren't able to run that in September 2020, but we will be running it across 2 sessions as a virtual event in February of this year. And we look forward to you joining us for that. Thank you again to our panel this morning. Your time, your comments, your input, and your expertise are much appreciated. And we'll say good morning to you all.
Thank you very much.
Bye, everybody.
Bye.